Hello, I'm Lawrence Spear from the OECD's Directorate for Public Affairs and Communications. Very happy to welcome you today to our webcast presenting the OECD G20 Base Erosion and Profit Shifting Project. Those of you who are online, thank you very much for joining us. We're quite happy to explain to you the entire BEPS process, the deliverables, what we've spent the last couple of years working on. We have quite a team with us today to deliver this technical presentation to you. You see there who our speakers are. I'm not going to spend a lot of time introducing them. So they'll no doubt tell you about their work and who they are. One thing I'd like to mention before we start the presentation, please do send us questions. You see on the sign right there, the email where you can send us. Follow us on Twitter. Please participate. At that point, I'm going to hand it over to Grace Perez-Navarro, who's the Deputy Director of the Center for Tax Policy Administration. Grace is going to give you an overview of where we are on the BEPS project today, and then we'll go into the technical presentations. Grace.
Thanks, Larry, and good morning, afternoon, evening to everyone, all of you out there in different time zones. Thank you very much for joining us. We started this project over 2 years ago. It's been a very fast-paced project that has been developed over the last 2 years. We have tried to make it as inclusive as possible, bringing in not only OECD, G20 countries on an equal footing, but also a number of other countries, regional organizations participating directly, and with over 60 developing countries working with us, participating through regional networks in Asia, Africa, Latin America, and Eurasia. The project has been a very transparent one. We've probably published more discussion drafts in a project than you've ever seen in any other OECD project, with 23 discussion drafts published, 12,000 pages of comments received, and 11 public consultations with stakeholders directly here at the OECD, but also through regular webcasts and through a range of conferences around the world to try and get everyone's input to deliver the best product possible. Now, we started this project with an article a long time ago, which was called, "What the BEPS Are We Talking About?" Well, we're here today to tell you what the BEPS we have done. And so what have we done? The BEPS package consists of minimum standards that all countries have agreed to ensure that we don't have situations where inaction by one country will have negative spillover effects on other countries. And for that reason, we've established 4 minimum standards that we'll be talking about later. We have also reinforced and strengthened our international standards in the areas of tax treaties and transfer pricing that Marlise will talk about later. We've developed common approaches and best practices for domestic law measures. And we have also developed analytical reports, 2 specific reports with recommendations, one on the digital economy and the other on the development of a multilateral instrument that will help us to quickly implement the treaty-related provisions of the BEPS project. And then last but not least, we have provided a detailed report on measuring BEPS. There were a lot of people asking, well, what is the size of the problem? We've spent 2 years looking at this issue, and we now have the answer to that problem. For many of you who have been following this work, this slide will not be new to you. We have structured our work around a 15-point action plan that can be broken down into 3 general pillars of work. The first being coherence, trying to create coherence between the interactions of the different laws of countries. Substance, reestablishing the link between substance and taxation. And then finally, increasing transparency and certainty. Now, in addition to those 3 pillars, we have these horizontal areas of work being the first and last actions of our 15-point action plan, the digital economy and the work on the multilateral instrument. Now, I know you all have a lot of questions, so I'm now going to turn it over to Achim Prost to talk about coherence.
Thank you, Grace, and welcome to everybody. I'm going to talk about coherence. I'm going to talk through the actions 2, 3, 4, and 5. And I'm going to kick off with two first, and that's the hybrid mismatch arrangements. Now, we've covered hybrid mismatch arrangement in some of the preceding BEPS webcast that we had, but I think it's not bad to kind of start out that this is one of the core aspects that we've always said in the BEPS project when we talk about double non-taxation or non-taxation. This is a classic example of stateless income. And in some sense, and we said this also before, this is, if you wish, not a victim, less crime. There is an aspect here, an erosion of the tax base of the affected countries. There's also aspects that don't just deal with revenue features. It affects fairness in terms of who pays the tax, that's labor versus capital. There's also a distortion of competition that only certain companies that can avail themselves to these sorts of cross-border structurings benefit from the lower rate, and it's not available to companies, whether they're large or small, that only participate in the domestic economy. It's also inefficient because it drives you towards structures that may be efficient on an after-tax basis, but not a pre-tax basis, and it's not an efficient allocation of resources. And last, I think the point also to make, it is not transparent. It is not transparent to the public. It is not transparent to the tax administration. Rates, effective rates, are being created that are not visible, and that creates a problem of transparency. And that is why we have had for a while a consensus that we need to do something about mismatch arrangements where they result in effects that are either non-taxed or long-term deferral of income. And so we've translated that policy into action, into a framework. That's the framework that we know. That is the framework that we already developed in 2014, which has three key aspects that make it up. One, we go for linking rules. That's to say we're not trying to harmonize the world. That probably wouldn't even be possible and probably also not desirable. So we're not going for harmonization of entity classification or instrument classification. We're going for linking. If there is double non-taxation where nothing would happen, we link to the tax consequences in the other country and close that one aspect where otherwise non-taxation would arise, and otherwise we don't touch the system. Minimum collateral damage. We also don't try to do this to some general anti-avoidance rule that probably would have resulted in a high level of uncertainty and is probably not in the interest of anybody. The second aspect is rule order, and that has a twofold purpose. One is to make sure that the system works whether or not all countries participate. And that's something that Pascal has already stressed earlier today. But secondly, and equally important, it also means that we're not going from a world of double non-taxation into a world of double taxation. So that's the importance of the rule order. And last, and equally important, the scope. It does not apply to every hybrid in the world. It applies to those, simply speaking, structured arrangements where people come together with the deliberate purpose of sharing a benefit, even where the parties are unrelated, or in the related party context. Why is this so important? This is important because you need to know the tax treatment on the other side in order to be able to apply the rule. And that balances the compliance situations, that makes it workable, that you restrict it to situations where that information can flow in the system. So that's where we were in 2014. Of course, now to answer the question, where do we get to in 2015? What's new? One, you have asked, and we have promised to deliver guidance on the implementation and operation of the rules, including transitional rules, and we've probably given you more guidance than you were expecting. We have extensive guidance out there now on the operation of the rules, with example, how transitional rules work, how it works if one country adopts the legislation in 1 year, the next country does it in the next. All of these questions we've worked through in the committee, and we have produced guidance on that. And then we had 4 specific outstanding issues. The first issue was the treatment of stock lending and repo transactions, and that raises questions where they may be such a high volume transaction, sometimes electronically, that you may not know whether the parties are related at that point. So how do the rules apply? And we now have specific guidance on that, and that's why you see a check. The second was the question, well, what happens if the inclusion does not happen at the level of the entity, but at the level of the shareholder, triggering a CFC inclusion? Is that an inclusion for purposes of inclusion deduction, or is it not? And again, now we have guidance on that. The third one is the guidance on the operation of the imported mismatch rule, and that is a rule that has no scope of application if every country applies the rule and implements the rule. But if that's not the case, there may be a situation where the hybrid is happening one step removed, and the country ultimately affected still needs to be able to protect itself And so we have a support for the coherence of the rules overall. And also here we now have guidance on which we've consulted also with business. So these are the three pieces where you see check. The last bit was the question that we discussed in 214, which relates to the treatment of hybrid regulatory capital, where it relates to the intra-group leg of that. And there we left countries a choice in that space, how they apply the rules, whether they apply the rule, and that is now reaffirmed also in the 215 report. So then let me just finish with the last bit on hybrids here. So how do we end up and where do we end up? We end up with rules that are comprehensive, and by comprehensive we mean they apply to all types of instruments and entities, and so we're not shifting from one transaction to another transaction, from an entity to an instrument, from one instrument to another type of instrument. It is comprehensive. It also applies whether or not every country in the world implements those rules. So there's no shifting of the problem. It is something that tries to solve the problem. It stops the hybrid, by which we mean only the tax effect of the hybrid. It tries not to interfere with the tax and regulatory consequences, because there's many very legitimate transactions that may create hybrid capital, and that is not a problem. What we're trying to do, and what we're only doing, what these rules do, is remove the tax benefit, so its tax is not the driver to this transaction. We also spend a lot of time to make sure that we don't go from double non-taxation to double taxation, and so the rules have a detailed commentary on how this works, the rule order, so we don't end up with avoiding with double taxation. And last, they're targeted and workable. They focus on the particular risk areas. And I should, of course, also say typically this is designed here so these transactions don't happen, rather than people being trapped in any of these rules. So that's where we leave it off on the hybrids rules. Let me then move to the next one, and that will be slightly more brief, and that's the CFC rules. We have agreed recommendations for the design of effective CFC rules to combat BEPS and long-term deferral. It's important to say they're not a minimum standard, so not every country is forced in some way that may currently not have CFC rules to legislate CFC rules, but there are building blocks with the combined knowledge of everybody in the room in the different countries, as Grace has said, have worked on this, of how do you design effective CFC rules. They have 6 building blocks. What is a CFC, CFC exemptions, the definition of CFC income, rules for computing the income, rules also for attributing the income to which taxpayer, and then importantly, also rules to prevent or eliminate double tax again. So we have this balance. We need to make sure there is no double non-taxation, but that should not translate into the creation of double taxation. We've also coordinated, and you'll see this in the report, with other actions such as the digital economy, the hybrids rule, the work on interest, and the work on transfer pricing. If I just pick up one key point that was very important that also came out of the public consultation, we recognize perhaps more clearly in the final report than this may have been the case in the consultation draft, that there is no one-size-fits-all. And what does that mean? The report recognizes that there are different underlying policy considerations that underpin CFC rules, and they will clearly determine the scope. So what are the aspects here? One, what we all have in common is it's a deterrent. What we all have in common, it's a backstop to transfer pricing. And what we all have in common is we need to balance the effectiveness with the compliance burden and the risk of double taxation. What may well be different, and you see this on the other side, is the balance between taxing the foreign income and maintaining the competitiveness with respect of the country of operation, but also with respect to third country M&Es that may be operating in that country of operation, and also the extent to which base stripping is covered, where it's parent stripping or whether it's also foreign to foreign based stripping. And that's very important that now flows through. There is no one size fits all, and that, I guess, and that's the last slide on CFC, that translates in terms of the key points. So on the definition of the CFC, we do cover certain transparent entities, such as partnerships and permanent establishments where they raise BEPS concerns. We also have, importantly, an anti-hybrid rule that picks up those hybrid situations that sometimes aren't picked up by CFC rules. Now they're picked up with that particular hybrid rule. CFC exemptions and threshold requirements make clear the use of whitelists, and that you should have meaningfully lower taxation to reduce the admin burden before CFC rule kicks in. CFC definition of income, as I said, it really depends on the policy objective, so there is room, there is a toolbox, if you wish, of how you can operate in that space, and a very strong focus on eliminating double taxation. Moving on then to action 4, let me restate in the beginning just briefly what the problem was, like I did in hybrids. And there it says that in the action plan, no or low taxation associated with practices that artificially segregate taxable income from the activities that generate it. That has 3 features. Feature number 1 is, where does the debt sit? And if you can shift all the debt to high tax location, that is a problem that needs to be addressed. And that also means that we are including third-party interest expense. Second is the quantity of interest relative to the actual gearing of the group. And third is the use of interest expense deductible to fund what is tax-exempt interest. And if I then move on, let me show you what the building blocks are of the rule that we are now proposing. And that is a fixed ratio rule, as Pascal has said earlier. It allows net interest deduction. We're talking about net interest up to a fixed net interest tax EBITDA ratio. Those are tax numbers, and both the interest and the tax number are taken from the tax calculation. It applies to interest paid to third parties and intra-group, and I think I've already explained why it is so important to also include third party. It's a fixed ratio of a range between 10 and 30%. As I've said, we have looked at data that's been provided also by BIAC and by PwC to assess the implication of this on businesses. If you look to third-party gearing and the consequences of this, you will see all of this in the report. And we have also given factors for countries to assist them in setting the ratio. It may not be that every country needs to be at exactly the same place on the ratio of 10 to 30. Some of these factors may be the interest rate environment. It may be whether you have a group ratio rule, which I'm going to talk about in a moment, whether you allow a carry forward. So there may be different elements that allow you to place yourself somewhere in the range between 10 and 30. Then we have, as I said, a group ratio that effectively ensures that the external gearing is always available for the group. So if your external gearing is higher than the 10 to 30%, the group-wide ratio allows you to always deduct that expense. At the same time, countries may instead have a different group ratio rule, for instance, equity clause, or no group ratio rule at all. What are we left? Our targeted rules, I come to those as well. We have a number of targeted rules that support the integrity of this. If related party financing tries to inflate the external gearing, we can address that. And we have some specific BEPS risks that we also address in these targeted rules. And finally, the optional elements that I've already mentioned. There is a de minimis threshold that can reduce compliance burden significantly. You take out the small pieces, low debt, the carry forward, the carry back provisions, both of the interest and the capacity they haven't used, allows you to smooth out the volatility that's inherent in a measure that's based on earnings. And we have a certain possible exclusion for third-party interest funding that is there for public benefit assets, such as may be the case for publicly funded infrastructure and similar projects. So the further work that we still have to do is more detailed work on the design and operation of the group ratio, and also some specific work around the banking insurance sectors that we will have to do over the course of next year. Both of these work streams will be completed by the end of 2016. And similar to hybrids, where does this leave us with? I think we have a measure that addresses BEPS involving interest. It does address the third-party issue. It does address the excess interest relative to the group issue. It does address the question of tax-exempt income, because in the measure of tax EBITDA, tax-exempt elements are not included. And it makes sure that the expense always follows the earnings. So if you shift earnings, you take in the expense with yourself, and you can no longer separate the two. It's flexible. It allows different countries to position them on a range, so it is something that's flexible enough to be applicable by a wide range of countries. It has a focus on BEPS. It focuses on net interest. It has elements, de minimis and other, to reduce and take out low-risk aspects. It's familiar and workable. A number of countries already have it, and it's based on data from the company itself. And I should say that we're still doing some further more detailed work on the group-wide rule, as I mentioned. And then I'm coming to my last point, which is harmful tax practices, Action 5. What did we set out to do in Action 5? And that's what it says in the action item. We required substance for all preferential regimes. We said that we are going to improve transparency, including compulsory, spontaneous, or as Pascal has called it, automatic exchange of certain rulings. We were going to engage with third countries outside OECD and the G20. And we were going to consider revisions or additions to the existing framework of harmful tax practices as it was developed in the 1998 report. So if we then contrast this with what we have delivered today, one, we have an agreed approach on defining substance for all preferential regimes, whether IP regimes or non-IP regimes. I'm going to talk about particularly IP regimes and the nexus approach because that's much of the focus of the work. So that's one. Second, we have completed a review of 43 regimes in OECD and G20 countries. You find the details and the names and the regimes in the report that we published earlier today. We have an agreed framework for the exchange of ruling in 5 clearly defined risk categories. And we've also agreed the deadlines and the format of those exchanges. We have agreed on an integrated approach for engaging with third countries, and that also feeds into what Grace will be talking about in the next step, the framework for the monitoring and moving forward. So we integrate those and we don't go on a one action by action basis. And finally, we have agreement that revisions or additions to the framework need to take into account the impact of the work on substance, such as nexus and transparency, such as the exchange of rulings, before we conclude on that. And now more specifically on both the nexus piece, the IP regimes, because that's key to the work, and then also on the exchange of rulings. The substantial activity, IP regimes, and nexus. What is the policy? The policy runs throughout BEPS, and the policy says realigning taxation with value creation. We have then translated that for the area of harmful tax practices by thinking the higher risk type of regimes are those that focus on the income rather than the deduction because they have more potential, they're more susceptible to potentially profit shifting. At the same time, we recognize that countries wish to encourage R&D, and if you put these policies together, then where you come out is in some variation of the nexus approach. You say to the extent that the company undertakes the R&D activity, to that extent also we shouldn't worry about a lower taxation of those amounts so generated. Importantly also, this is not a policy recommendation, but a box around a box where we're saying if you do something in that space, then we will not consider it as the international community as affecting the neighbor, as being harmful, but whether or not you have a box, what sort of box you have, is a policy question on which we're making no recommendation. The basic approach, as it says on the lower part of the slide, is a proportionate approach. So the amount of benefiting income depends on the proportion of R&D activity incurred by the taxpayer that wishes to benefit. That's one. And we have included in qualifying expenditures outsourcing to unrelated parties. We see them as less risky and also probably by business reasons limited, but not outsourcing to related parties or acquisition. And as we already announced earlier, there's an allowance for a 30% uplift. So if we then go, what's new since February, when we last released something in the area of harmful tax practices? One, we have an agreed approach to tracking and tracing, including transitional rules, that balances the business concerns with the compliance needs of governments. Second, we have an agreed definition of qualifying IP assets that was left open at the February communique when we issued that. And so it now includes 3 specific categories. Patents defined broadly, and that also includes utility models, etc., and some others. Copyrighted software that in some countries have patent protection and others they do not. And they are the same type of R&D innovation that is also inherent in the patents broadly defined. And similar IP asset that meets specific conditions, including restrictions on company size and the amount of benefiting income, largely in the SME sector where it may be too costly to patent what otherwise would be patentable. We also have agreed safeguards. I'm not going to go into the details of those. You can read them, that kick off on January 1 to 16, and the transparency one that already kicked off on 6 February 2015. I then move, and that's where I will finish also, I'll move to the transparency part here and focus on the compulsory spontaneous exchange of rulings. On the left-hand side, you see the categories of rulings on which we are requiring through the work the compulsory, spontaneous, or Pascal has said automatic exchange. So it's not every ruling. It is those rulings that are clearly focused on particular risk areas. On the other side, you see with which countries those need to be exchanged with on the basis of existing exchange instruments. And then last, you see the slide about the timing. As I said, we have details on when this is meant to happen. So past rulings, as they're defined, you see on the slide, need to be exchanged by the end of 2016. And for future rulings, there is an ongoing process of exchange within 3 months. So you see those systems. So with that, I think I have concluded on these actions so far. Thank you, Larry.
Achim, thank you very much for running us through those first 4 items of the action plan. We're going to move to the second pillar on substance, and with that, I'm going to hand it over to Marlies de Ruyter. Marlies?
Thank you very much, Larry, and also from my side, good morning, good afternoon, good evening to all of you that are watching. What I'm going to talk about is substance. So that are the changes to the international standards, the existing international standards that are necessary to align the outcomes of those standards with the intentions that were then there when the standards were introduced. So to make sure that the outcomes are in line with value creation and substance. I will do that by first looking at the Model Tax Convention and the changes made in that, treaty abuse and permanent establishments, and later on I will go into the changes on transfer pricing. But I will start with treaty abuse, and treaty abuse is one of the major reasons for BEPS to be there. It's one of the most important sources of BEPS. And why is that? Maybe to remind you, if you are a multinational group and you wanted to have access to treaty benefits, but you did not have an entity in a country with a very favorable treaties, the only thing that you needed to do is to interpose a letterbox company, a letterbox entity in that jurisdiction in a transaction, and by doing that you could create and you could access those treaty benefits. So kind of these money streams flowed around the world to the low tax environments where the money streams needed to go, royalties, interest, and dividends. So this was more or less the highway to tax heaven. And that's what we wanted to prevent with the treaty abuse provisions. And that's why we also thought that a minimum standard was necessary in this context. So treaty shopping will be prevented. All OECD and G20 countries have agreed to the minimum standard and will introduce effective measures to target treaty shopping. However, treaty shopping is not the only form of treaty abuse. There are other forms of treaty abuse, for example, dividend transfers, use of dual resident companies, and also for those measures are being proposed in the guidance. And we are doing that in 2 ways, by introducing specific anti-abuse rules, but also by introducing more general anti-abuse rules. Why are they both needed? Specific rules provide certainty, they are clear, but you can never guess what will happen in the future, and therefore you also need some general rules that will prevent future abuses. So what's the minimum standard then? It's a combination of measures. First of all, what you need to do to prevent treaty shopping is to include an express statement in your treaty that these are not intended to be used for treaty abuse and treaty shopping. And then you can introduce kind of a combination of measures, either a general treaty anti-abuse rule or what we call a specific anti-abuse rule, being a limitation of benefits rule, including a anti-conduit rule that you need to prevent financial treaty shopping. And then you can also do both, the limitation on benefits and a general treaty anti-abuse rules. Why these combinations? There are different preferences between countries, and therefore we have given countries to be the possibility to be flexible, to do their preferred approach. But I can guarantee you that all of these approaches will be very effective. So does that mean that we are ready with treaty abuse? More or less. There are a couple of open issues that we need to look into. The US changed their treaty policy in relation to the limitation on benefits clause. So there will be some refinements in 2016. The same in relation to non-CAV funds. That's something we need to look into. But that will be finalized by the end of 2016 when the multilateral instrument where this needs to be included will be finalized. So that brings us to preventing the artificial avoidance of the PE status. And these changes address techniques used to inappropriately avoid being taxed in a state while you do have economic presence in a state. And that can be done by replacing a distributor by a commissionaire arrangement. Pascal already referred to that in the previous webcast. You can also try to make use of per se exemptions that are in the treaty and that were meant to kind of alleviate administrative burdens for preparatory and auxiliary activities. However, these activities have moved from being preparatory and auxiliary to being core activities, for example, warehousing. And then there is also the issue of fragmentation of activities and splitting up of contracts. And these will be addressed through the measures that are being proposed. I want to zoom in on commissionaire arrangements because all the others were discussed in previous webcasts. And the aim of that change is that as a matter of policy, where the activities that an intermediary exercise in a country are intended to result in the regular conclusion of contracts to be performed by a foreign enterprise. So you perform activities, it leads to a contract, and then there are always activities performed by these foreign enterprises. That's what you want to capture in a permanent establishment. And that is what will be changed in the treaty provisions, capturing that material leading to contracts, while previously the conditions were much more formal and easy to change through artificial structures. So what does that mean for where we are on this issue on PEs? On permanent establishments, it is, of course, very, very important to also know what profits will be attributed. And there will be follow-up work in that respect in 2016. That will be finalized by the end of 2016, and that also allows this work to be included in the multilateral instrument. Given that, there were last kind of final changes made to the wording at very last stages, what we also want to do is make sure that the commentary is as good as possible. So there may also be refinements in the commentary that we will prepare in 2016 that will be included. So that leads us from the treaty changes to the revised transfer pricing guidelines. And here we had 3 action points, 1 report, 187 pages long. So extensive guidance there. And if you look at that guidance, it rotates around one kind of notion, the notion of aligning transfer pricing outcomes with value creation. Where is the value created? And that is done through 6 interlinked sections. 1 on applying the arm's length principle, 1 on commodity transactions. Further work will be done on profit splits. We have guidance on intangibles. We have guidance on low value adding intragroup services. And we have guidance on cost contribution arrangements. And the combination of these sections will target BEPS very effectively in the transfer pricing area, and I will come back to that. What is important is that this is closely linked to the report on Action 13. You cannot apply guidance if you don't have sufficient information, and that information is being provided by Action 13. So what are the key themes in the transfer pricing outcomes? The first and probably most important theme is that the accurate delineation of the actual transaction is fundamental. So Contracts are a starting point to look at what kind of transaction needs to be priced, but it's looked at in combination with the conduct, and if the conduct contradicts the contracts or adds to the contracts, then the actual transaction is delineated based on the conduct. So those elements are taken into account, and that makes sure that you price reality and not kind of paper reality. The second notion is that legal ownership alone does not create entitlement to profits. Entitlement to profits comes from the important functions that are being performed, risks that are being assumed, and not mere legal ownership. Then on the provision of funding, of course, funding is one key economic activity, but funding alone will not generate more than a risk-free financial return. You do need to do more to generate a higher return. And then this goes back to the risk bit, and that is that differences between the anticipated and actual profits are allocated depending on assumption of risk and the functions that warrant a profit share. So where risk is assumed is a key element, and I will come back to that. And then the last notion is that information asymmetry and lack of transparency are addressed. Hard-to-value intangibles, commodities, and services are areas where this comes back. So this will lead to profit attribution in line with value creation. It will make sure that the most important functions, assets, and risks get the profits that they deserve. So how is risk then allocated between the parties? We have a framework developed that kind of takes account of all the steps you need to take to do that. So first you need to talk about what risk are we talking about. And one thing to recognize is that kind of risk-taking and risk assumption is key to doing business. Each business opportunity comes with risk, and the higher the risk, the higher the anticipated return that someone will expect. And that led to all kinds of base erosion and profit shifting structures where a contractual allocation of risk was being made in order to get tax benefits. So identification of the risk is the first crucial step. You need to know what risk you're talking about. Then the second question is, so how is that risk contractually assumed between the parties? Who is responsible for what kind of payments? Who will bear the consequences if the risk materializes? And then we go into the functional analysis, and we will look at whether, what kind of activities take place around the risk, who take the decisions in relation to the risk, who manage the risk, who mitigate the risk, who perform the risk mitigation activities. Is there any insurance, and who pays for that? And if the risk materializes, who has paid for the consequences of that? So that's all in the functional analysis. And then we will try to assess whether the contractual assumption of risk is aligned with conduct and the other facts. So, for example, if the contract says, Party A is assuming the risk, and what you see in practice is that Party B is actually kind of bearing all the costs and performing all the activities that are needed when the risk materializes, then you can wonder, where is the risk assumed? Another step that you will need to take is to make sure that the party that contractually assumes the risk has the control over the risk and the financial capacity to assume the risk. And these are two very important notions in the work on risks. So I would like to take a couple of minutes to go into these two issues. Control over risk, what is that? And it's a very meaningful and very specifically defined kind of control notion. So it evolves around decisions to take on, lay off, and decline risk-bearing opportunities, but also decisions on how to respond to the risk. And it also evolves around risk mitigation functions. So the one controlling the risk needs to have the capability to take the decisions to take on the risk, to lay off the risk, to decline the risk-bearing opportunity, and needs to take the decisions on how to respond to the risk. It needs to have the capability to do that, but it also actually needs to do that, needs to actually decide. Does it also need to do the risk mitigation functions? Not necessarily. Does it need to do everything in relation to the risk decision-making process? No, it can outsource some kind of preparatory activities. But if it does so, it needs to control these activities by setting the objectives, assessing whether the objectives are met, hiring and firing the one doing the outsourced activities. So it's a really meaningful control notion. And what the draft very explicitly says is that it's not sufficient to fly in your directors to a nice location with a nice tax climate. It needs to be more. We are going to look at the full process. Then you also need to have the financial capacity to assume the risk. So what do we mean with financial capacity to assume the risk? What we mean is that you need to have the funds to pay. You need to have the funds to pay for insurance, for example, to pay for risk mitigation, to pay if the risk materializes. And those funds can come from multiple means. It can be capital, it can be a loan, it can be funded by your day-to-day activities. But the key element is that the expectation is there that you have those funds. What if you don't have control, and what if you don't have the financial capacity to allocate the risk? In that situation, the risk will be allocated to the party that does control the risk, including the anticipated returns in relation to that risk. So that is the framework in relation to risk. Then in relation to intangibles, another very important part of the work. As I said earlier, legal ownership alone does not give a right to ultimately retain the returns from exploitation of the intangibles. The anticipated returns will go to the important functions, which are the functions in relation to development, enhancement, maintenance, protection, and exploitation of the intangible. However, funding is also very important. No investment without funds, and funding often coincides with taking certain financial risks, even if you don't perform any development activities. Provided that you exercise control over those financing risks that you take, you will get a risk-adjusted financial return. And that financial risk that you are taking is separate from, may be linked to the development risk. So you need to know something about development, and the more complex and the bigger the project is that you invest in, the more closer you will be to the development activity. A funder which only assumes a funding risk but does not perform functions in relation to the intangible will get the risk-adjusted financial return. But sometimes the funder does not even control the financial risk. For example, it doesn't know anything, it just pays out. It doesn't look at creditworthiness of the one to which he kind of gives the loan. Or it doesn't even look at whether the development activities are going into the right direction, while it is a very complex kind of investment that is being made. In that case, it will get no more than a risk-free financial return. And as we know, that is very low at the moment in many countries. So why is there no more? Can it be lower than a risk-free financial return? Yes, it can. If it's an artificial structure, non-recognition will kick in, and that may mean that you won't get anything at all. So does that resolve all problems in relation to intangibles? No, it doesn't. We have the problem in relation to hard-to-value intangibles, and the definition already indicates what the problem is. So you have intangibles where there are no reliable comparables, and it's very difficult to make financial projections or other assumptions for valuation of those intangibles. And in that situation, it's impossible for tax administrations to assess, what's the value of this. And that impossibility is heightened by the fact that you have information asymmetries. Taxpayers know everything about the research and development, but the tax administration, they don't know about development. They don't have the expertise that the taxpayer has. So there's an information asymmetry. And therefore, it was decided to include a special approach that if the taxpayer cannot demonstrate its pricing is based on a thorough analysis, that the ex post outcomes are presumptive evidence about the appropriateness of the ex ante pricing. So it's not hindsight, it's assuming a kind of commensurate with income approach. That can be rebutted. You have exemptions. If you prove that the difference between the ex ante valuations and the actual return is down to the fact that there was an unforeseeable development, for example, a competitor went bankrupt, in that situation, we can say, hey, there is a good explanation and this approach is not needed. So what other new guidance do we have? We have guidance on commodities where the quoted prices and the pricing date is clarified. Very important for developing countries, as this gives them the opportunity also to address information asymmetries in relation to commodity transactions. We have an action in relation to low value adding intragroup services, an approach where we say for services that are there in every multinational group but that do not lead to very high risks, we give a simplified approach that also gives a lot of transparency to developing countries so that they know they are not overcharged for these activities. And then new in this approach, new in the guidance, cost contribution arrangements, and this aligns the guidance of CCAs with the guidance on risk and intangibles. And therefore it is significantly changed. And it will lead to no more leaking away of value to other participants, because the contributions that are on the pre-existing value, they need to be kind of valued at value. So all pre-existing contributions need to be valued at market value, and the current contribution can be done at cost, but then you need to take account of the opportunity cost also. So leaking through CCAs is no longer possible also. So where does that lead us? I already gave you some important notions. There's one that I didn't mention because it was mentioned in earlier webcasts. The current guidance also takes account of groupness and synergetic benefits. These benefits will be allocated to the entities that contributed to them, and they cannot be isolated out to, for example, a nice low-tax location. As I already illustrated, contracts alone do not attract profits, and besides that, simplification and practical approaches can be achieved within the arm's length principle, as illustrated by the guidance on low value adding services and hard to value intangibles. So does that mean we're done, that the work on transfer pricing is finished? No, that doesn't mean we're done. Attentive listeners will have missed some things that we promised to do. We are going to do additional work on profit splits, financial transactions, and we will consolidate the changes within the transfer pricing guidelines. Besides that, there will be additional guidance on the implementation of hard-to-value intangibles and low-value adding services. And also very important in this area is the work mandated by the G20 Development Working Group on transfer pricing toolkits for low-income countries. Developing countries will have a lot of benefit from the outcomes of this report, but they have indicated they have also got additional challenges, and these will be captured in toolkits that are specifically designed for them through an additional project that we are currently undertaking, and the outcomes will be presented in 2016 and 2017. So that were the most important outcomes of the substance measures.
Well, thanks very much, Marlies, for running us through those elements. We're going to shift now to the pillar on transparency. Just before I hand off the floor, I'd just like to mention we're getting a lot of questions from folks out there watching. Yes, the answer to a frequently asked question. The slides will be available online just after the presentation. You'll find them on the website. Don't worry, you will have access to all of this material. This actual website as well will shortly be, the webcast will shortly be put up for rewatching for those who may be missing it. I'm going to hand the floor over now for the first element of the transparency pillar, which is measuring and monitoring BEPS. I'm going to ask David Bradbury, the head of the Tax Policy and Statistics Division. David.
Thanks very much, Larry, and good to be with you all, wherever you are around the world. Action 11 involves the measuring and monitoring of BEPS, and this is very much the data and the economic analysis piece of the BEPS project. And to recap, there are 4 elements to the work that we've been undertaking. Firstly, we have been undertaking an assessment of existing data sources. We've been producing indicators of BEPS. We've been undertaking an economic analysis of BEPS and the actions taken to address it, and we have produced recommendations. So in terms of the key findings, what are the key findings of the work that we've undertaken under Action 11? Well, firstly, we've identified that better data is needed to measure and monitor BEPS and the actions taken to address BEPS into the future. We note that regardless of whether it's microdata or macro data, better data is required. And in addition to that, we also note that when it comes to data, all forms of data are already tainted by BEPS, and that makes the challenge of measuring and monitoring BEPS even more difficult. But we've noted in the report that better data, including by using the country-by-country reports, will improve future economic analysis, and that's an important point. But in spite of these data limitations, we have brought together many of the prior empirical studies. We've also produced new OECD research, and we've produced the indicators that we were asked to produce. And all of those pieces of work have come together to demonstrate the existence of BEPS. In all respects, we find the existence of BEPS, and we find that BEPS creates significant fiscal and economic effects. New OECD research that is presented in this report that draws upon the best available data finds that global annual net revenue losses are in the order of 4 to 10% of corporate income tax. So that's a figure that's in the range of between $100 and $240 billion US. That's at 2014 levels. So it's a significant amount of money involved. In terms of the economic arguments, we have certainly been able to assess that there are economic distortions and economic effects that are adverse effects that are caused by BEPS. In terms of the economic analysis, it's worth noting that the report draws together over 100 empirical studies, or notes the existence of over 100 empirical studies that all report evidence of BEPS. That is one thing. It's also worth noting that there are, in fact, very few studies that have gone that next step to try and quantify the global estimate of the scale of BEPS losses. But we have, in the report that we've presented, produced that estimate of between 4 and 10% of corporate income tax, which is the $100 to $240 billion figure at 2014 levels. It's worth noting that both the methodology and indeed the results are largely in line with those other studies where similar efforts have been undertaken. It's worth noting that BEPS creates many economic distortions, and some of the distortions that the research presented in the Action 11 report demonstrate are the differences in effective tax rates between large multinational enterprises and similar domestic firms. We see a difference of 4 to 8.5 percentage points in terms of the effective tax rates faced between those two different types of entities. Obviously, that has impacts in terms of competition. We find that BEPS favours intangible investments, it favours companies locating debt in high tax countries, and it also distorts the location of FDI. And importantly, BEPS creates negative tax spillovers across countries. One of the findings of the economic analysis is also that anti-avoidance rules are effective in preventing BEPS in individual countries, but we also note that it is most likely that if implemented in a coordinated way, the effectiveness of those measures would be much greater. As part of the economic analysis, we also note that while taxes matter significantly in relation to the shifting of mobile income, more analysis is still needed on the extent of the tax effects on shifting real economic activity. In terms of the recommendations, the key recommendations that have been made relate to data and tools for future monitoring. The principal and the main recommendation is that the OECD work with governments to publish a new regular corporate tax statistics publication. Now, importantly, this publication would be working with governments to ensure that we compile a range of relevant data that is in an internationally consistent format. And this will include, in both an aggregated and an anonymised format, statistical analyses prepared by governments that draw upon the country-by-country reports, which we believe will be a very significant source of information for statistical analysis in the future. Another recommendation involves the OECD working with governments to refine the indicators that we have produced for this report, but to also produce periodic reports on the estimated revenue impacts of the proposed measures and indeed those measures that are enacted. We note that much more research is needed in relation to M&Es, and in particular we encourage more of this research to be undertaken by tax administrations in collaboration with academic researchers. And the final concluding point in drawing all of that together is to note that it is only with better data and more refined analyses that we will be able to improve the measurement and monitoring of BEPS and indeed the actions taken to address BEPS into the future.
David, thanks very much for that. One of the most eagerly anticipated elements, I think, in the project, understanding what is BEPS. We're going to move on in this transparency pillar straight back to Achim to talk about mandatory disclosure rules. Achim, please.
Thank you. And yes, this will be a brief one. And as you said, Larry, this is part of the transparency pillar here. And there's also going to be country-to-country reporting. Now, this piece here deals very specifically with an issue the tax administrations often face, which is that they don't have the information early enough or comprehensive enough, and they don't get it, and so they can't react. And this is something where the mandatory disclosure rules come in. They require disclosure, often even before the tax return is filed, of particular transactions, and that's defined by promoters, by taxpayers, or both. And there are certain advantages to these. There is the advantage that it's received early. There is the advantage that it's received on a mandatory basis, so it's much broader than rulings. It can be applied to a broad range of taxpayers. There's some flexibility, and you can target it at risk, and it can change in transactions of particular concerns that we sometimes term as hallmarks. And so what we've done in this area, and this is a best practice for those countries wishing to introduce those sorts of measures, is to basically give you three things as governments. One is we have agreed a framework for the design of rules that are flexible to country-specific risks and needs. Not everything is the same for every country, so we have given a framework that is ready for use in that space, and I think that's an important part of how we've designed it. The second piece goes to a specific recommendation for rules that focus on international tax schemes, because that is very often the type of thing that you may not be able to capture under the existing mandatory disclosure rules, because it sits on the border between the two countries and it's something to pick up. And last, we've also thought about how this information can actually be worked within a tax administration, referring also to some of the work that we're doing on the FTA, on the former tax administration side of the house, in this JITSIG framework. And given that that's my last slide here, also on the action item, just a brief word that you see me speaking on all these action items, but I'm just the pretty face, and of course the team put all of this together. But that's just a brief word, and I hand it back to Larry.
Thanks, Achim. We're going to continue into the transparency pillar with Marlies talking about transfer pricing documentation and dispute resolution.
Thank you very much, Larry. Yes, and for those that have now received all the reports and the big package and that are wondering where should I start reading, My suggestion is not with country-by-country reporting, because there's nothing new if you have already read the previous reports. It's a consolidation of the previous reports. The only thing new is actually the executive summary, and the reports have been aligned, but there's no new guidance in there. This is interesting to look at. It's a kind of a timeline. What can you expect? Companies will be expected to start gathering information in 2016 on country-by-country reporting. Then they will have to put it together in 2017, and that means that the first country-by-country reports will become available in 2018, and then tax administrations, because it's the first time, will have 6 months to exchange information, and that will kind of go back to 3 months in the years following. So this is an interesting kind of graph for those that are interested in the timelines. So what is next on country-by-country reporting? As you may have seen, that adoption of domestic legislation where needed is in progress. Not all countries need to have that legislation, for example, the United States, but those countries that do need are starting to include it in their budgets that have come out. Then there will be an XML schema and a user guide that will be provided by the end of 2015. We will have a signing ceremony on the multilateral competent authority agreement in January 2016, and then we will have a review of the implementation package in 2020. So this one is already kind of being implemented as we speak. So that leads us to the next kind of action item that I'm also taking, dispute resolution. Pascal already talked a lot about this in his webcast. So as he said, we're not doing that great. This is kind of a graph on the MEP cases that are initiated per year, that are given to us for our statistical information, so mainly OECD countries. And this is the graph of those that are resolved, and as you will understand, this has led to huge caseloads of outstanding MEP cases. So what are we going to do on that? We have agreed to a minimum standard, and that minimum standard will be supplemented by a peer review mechanism to make sure it's implemented. And the minimum standard is really a practical minimum standard, taking countries through the steps that they need to take to make sure that the mutual agreement procedure is accessible, to make sure that the competent authorities are empowered, and to make sure that a resolution is achieved. And a peer review mechanism will make sure that that actually happens. Then there's also a supplementary commitment by more than 20 countries for mandatory and binding arbitration. And if you look at the caseloads I just showed, this will cover more than 90% of the caseloads on which we have collected statistical information. So that is a very good outcome on dispute resolution. So where does it leave us in the process? So for implementation, we need a monitoring process, and the terms of reference and the assessment methodology will be developed in the first quarter of 2016 by a joint group also involving the FTA MEP Forum, because the Forum on Tax Administrations is one of the groups that is responsible that will be responsible for the monitoring. So also from my side, this is my final slide. I'm the face. I'm not the one that put together all the work, and I would like to thank my team, and I would also like to thank someone that left that's no longer in my team, Joe Andres, who put together the country-by-country reporting template and did a wonderful job on that. So thank you very much.
Thanks very much, Marlies. We're going now to move into the final elements of the BEPS action plan that we haven't discussed yet, the horizontal work. Rafael Russo, who's the head of the BEPS project, is going to talk about the digital economy, the multilateral instrument. Rafa.
Thank you, Larry, and good morning, good afternoon, everyone. I think by now you have a better idea of the content of the package. What I'm going to do is to talk about the two actions that were horizontal in nature. First one on the digital economy, action 1 of the BEPS action plan, and then action 15 on the multilateral instrument. On the digital economy, and here I would like to underline a couple of things. This is a report, as all the other reports in the BEPS package, that has been agreed by consensus by all the countries participating in the work. And they all agreed that it is not possible to ring-fence the digital economy for tax purposes. So special tax on digital economy are out. Second, there was agreement that the digital economy presents some key features and fosters some existing business models or new business models which raise related but different issues. And the report tries to clear the air in that respect. One thing is to talk about BEPS, instances of double non-taxation, artificial segregation between taxable income and economic activities. One thing is to talk about what we have named the broader tax challenges, issues that are more systemic in nature. If we talk about BEPS, sub-conclusion, there are no unique BEPS issues in the digital economy. The same BEPS issues that arise in more traditional environments arise in the digital economy, but they may be exacerbated by these key features, and in particular mobility, in particular network effects, and the reliance on data. Now, these key features and these BEPS concerns in the digital economy have been taken into account and addressed in the work that was described by, in particular, Marlies and Hakim. For example, in relation to the definition of permanent establishment, the changes to the agency permanent establishment definition will have a major impact on schemes, on structures that have been implemented by digital economy players. Same for activities that in the past were considered to be of a preparatory or auxiliary nature, like warehousing, for example, which today may be core components of certain business models. Transfer pricing, the focus on delineating the actual transaction, the specific guidance on intangibles, and in particular the special approach on hard-to-value intangibles, as described by Marlies, are expected to have a major impact on these schemes, together with the recommendations on best practices regarding control foreign company rules. As Hakim said, there is flexibility there, showing different underlying policy objectives, but all the options that are given cover income from digital sales. Why? Because this income has now become mobile. And therefore, if CFC rules are targeted at mobile income, they may want to cover that. What's the conclusion of the countries participating in the project? Well, the conclusion is that these measures are expected to address the BEPS issues exacerbated by the digital economy. Then we move on to the broader tax challenges. And here we are talking about both direct and indirect taxation. In the area of indirect taxation, one of the major issues was the collection of VAT or GST on business-to-consumer transactions that happen across borders. Why? Well, first, because it was not clear what principle should apply, and second, how to apply whatever principle. Now there is global agreement, and this is thanks to the work of Working Party 9, and the agreement is destination principle. VAT, GST collected in the country of destination, with a number of mechanisms that would, in practice, render the collection of this VAT possible. Done, agreed, and actually already being implemented in a number of countries. Second, the modifications to the preparatory auxiliary activity exceptions on Article 5, there was a discussion at a certain point, well, but we should change these only for BEPS issues, not also for other issues which are broader than that. Well, the agreement in the digital economy work was you change them because now the business models have changed. So whether this raises BEPS issues or not, it's something to be done. Again, done. At the same point, there were issues that were more confused in the public debate. The issue of nexus, which is different from the nexus mentioned by Hakim on harmful tax practices, is about you can do business in a country without being physically present. And the issue of data. You can collect data from a country, elaborate them, and then monetize these data. should this trigger a tax liability in the country concerned. What the work produced is a number of potential options that could deal with these challenges, ranging from a significant economic presence test, so a threshold for the taxation of non-residents which is not based on physical presence but is based on revenue factors combined with a number of other factors like digital factors, user-based factors, in any case factors that demonstrate the constant interaction with the economy of another country. Second, a withholding tax on digital transactions. And third, an equalization levy that would probably solve the issues related to attributing profits to such a significant economic presence. The work advanced on these issues, on these options, the technical issues were identified, and the conclusion was we don't need to adopt these as internationally agreed standards. Why? Well, because as I said before, the agreement is that there is an expectation that the BEPS measures will address these issues, and also that it's not clear the extent of these challenges at this stage, although the trend is that these challenges are increasing over time, and therefore the report concludes that if countries want, they could introduce those in domestic law, provided they respect their treaty obligations, or bilaterally if there is agreement with the other country. Why? Because this is an issue that touches upon allocation of taxing rights among different tax jurisdictions. And because this is such a systemic issue, the agreement was to continue to monitor developments in the digital economy that have an impact on tax policy. Think about 3D printing, think about robotics, the sharing economy. These are things that are going to have a strong impact on the way tax policy is designed in the future. In addition, new data will become available from the country-by-country report, from the monitoring of Action 11, from the VAT declaration, and on the basis of this data, it will be possible to take a decision on whether further work should be done multilaterally on these three options. To do so, a detailed mandate will be developed next year in the context of the inclusive follow-up to the BEPS project. If I move to the multilateral instrument, and here, again, very little surprise, because we have already spoken about that. There was a report which concluded that using a multilateral instrument to implement the BEPS treaty measures is feasible and desirable. We're talking about Action 2 on hybrid entities, Action 6 on treaty abuse, Action 7 on permanent establishment, Action 14 on dispute resolution. This is all being done. There are 90 countries around the table, all on an equal footing, that are discussing the drafting of this instrument, with one of the last countries to join the work being the United States. The first meeting was a procedural meeting, was held in May, and there will be an inaugural meeting in November. There will be consultations with the stakeholders on the different aspects of the work, with the intention to open the instrument for signature in 2016.
Rafa, thanks very much. We've now run through the entire BEPS package. I think everyone can just take a moment and sigh, because that's quite an undertaking. And I'm not going to thank anyone about the slides or the work, but the people here at the table, it's really quite an undertaking. You've heard about it before. Now we're going to look forward. And I think that what's important about the next couple of presentations and then your questions is looking forward, where is this process going? We're going to go straight back to Rafa to talk about the expected impact of the BEPS package.
Thanks, Larry, and I'll try to be as fast as possible in the interest of time so that we can reply to some of the questions, but people have already had more than half an hour of Sant'Amar replying to questions, so hopefully there are not so many. Now that you have heard from everyone on what the BEPS package is about, we just wanted to run you through like a basic taxonomy of what we expect the impact to be. So normally what do you have? You have a country of residence where the headquarters is located, and then you have a number of other countries, which can be the country where production takes place, where sales take place, and that can be 1, 2, 3, 4, or 25 countries. Doesn't matter for the purposes of our example. The reality is that in real life, in many of the schemes that we have seen, what you see is that there is something in between, with the interposition of usually an intermediate country which facilitates the investment, a hub, and then like a no or low tax jurisdiction where the income ends up ultimately. How does that happen? Well, first, in the market or production country, the aim is to avoid a taxable presence, the structures with commissioners that Marlies described, prepare their auxiliary activities, or, if there is a taxable presence, to minimize assets and risks that are allocated to this taxable presence. Then, every payment that goes out usually goes out via favorable treaty jurisdiction, therefore with low or no withholding tax on the basis of the relevant treaty. And the income in that jurisdiction is very lightly taxed, either because deductions are maximized, because hybrid mismatch arrangements are used, or because there are preferential regimes in place that basically allow the income to be taxed at very low rates and be transferred to the ultimate intermediate company, usually in a non-tax jurisdiction, without any withholding tax at source. How? Maximizing assets and risks, usually under intra-group contracts in this jurisdiction. Finally, same planning usually strips the taxable base of the parent country, maximizing deductions, minimizing assets and risks, and in addition, avoiding the application of any applicable controlled foreign company regimes. I think by now it should be clear to most people what we have tried to do with the BEPS package. So if you take the work on permanent establishment, that's the impact that we are expecting. If you then add on top of that the work on transfer pricing, you see that basically it reallocates the income where it belongs. That is, where the economic activities are carried out and where value is created. How do you then prevent the use of deductions to strip the taxable base out? Is the work on Action 4 that Takim has described in detail regarding interest deductibility. How do you prevent that payments that go out do not benefit from double tax treaties when conduit structures are interposed? Action 6 with the minimum standard. Add on top of that the work on Action 5 that basically, as Akim has put it, has put a box around the box, in particular as regards preferential treatments on intangibles, and the work on hybrid mismatch arrangements, which effectively prevents double non-taxation due to lack of coordination between two different tax systems. On top of this, the recommendations, the best practices in the area of CFC rules, we do believe that the impact of the BEPS project is that basically those that want to continue to take aggressive position will have very little interest in doing so, because the financial benefit will not be there and because of the scrutiny that is out there. Scrutiny that will come out in particular from the Action 13 work on transfer pricing documentation, master file, local file, and the country-by-country reporting. Those that do not take aggressive position, in our expectation, will benefit from more certainty and more predictability. Why? Because the resources of tax administrations will be targeted on those that walk on the thin line between what's legal and what's not.
Rafa, thanks very much. Without further ado, I'm going to hand the floor right back to Grace to talk about what's next, the following steps.
Thank you, Larry. Well, there's been an awful lot presented to you, and you have a lot of homework to read, over 1,000 pages of reports. It's not over yet. There's a lot more to be done, and that really focuses on implementation. Yes, we have these new rules, new and revised rules on different aspects of our work. As you've just heard, we will be carrying out additional technical work, as I think Marlies, Rafa, and Achim and David have already described. In addition, we need to focus very carefully on ensuring effective implementation, and this implies a number of different things. It implies, first and foremost, ensuring that tax treaties get updated to implement the tax treaty-related aspects of this work, and that will be done through, we hope, the multilateral instrument that Rafa has just described, but also countries can amend their bilateral tax treaties separately as well. there's the transfer pricing guidelines that will need to be formally updated to include all of the new provisions that Marlies has described. And then, of course, there are some of the actions, most of the ones that Achim described, that will have to be implemented through domestic legislation. In addition to all of that, a lot of the post-BEPS package work will fall on tax administrations. They will need to see how they use these new tools, the increased transparency, to more effectively audit and assess risk. These are going to be important new tools that they will need to learn how to use. In addition to that, we are planning to establish monitoring, and I think we've already heard some aspects of that. But we will be establishing a monitoring framework. We've started with monitoring on the dispute resolution aspects. We have already set up the FTA map forum, but we will be having monitoring of all aspects of the project so that we can ensure that what we have done turns out to be effective, to make sure that there aren't any new loopholes that arise, and to make sure that there is consistency in the implementation and that we achieve a level playing field. Now, how are we going to do this? One of the main things that we will be doing is to develop an inclusive framework. I started this presentation earlier on talking about the number of countries that have been involved and the different ways that we've tried to get countries involved in this. The G20 has now mandated us to establish an inclusive framework to bring in all interested countries to look at these issues of implementation and also monitoring. The implementation, as I said, is going to be key. We need to help countries implement these rules if they're interested in doing so. We can't just put out these very complex rules and then leave countries on their own. So that will be a big part of the follow-up work, and we will be establishing this follow-up mechanism over the next few months. Obviously, the G20 gave us this mandate earlier in September, so we will be spending the next few months, as I think Pascal said in the earlier webcast, to try and establish this framework by discussing this with all the countries that have been participating in our work to see how we can establish something that is valuable, meaningful, and helps countries implement these rules in an effective manner and to ensure that we establish a level playing field. I want to stop there because I know there are a lot of questions. And before I do that, since this is our last webcast, I do want to thank the people you have heard from right here because they have been the drivers of the different aspects of this project, and they and their teams have delivered this extraordinary amount of work. So let me just end with that and turn it back over to Larry to give us some questions.
Okay, Grace. Then the first one is going to be both, let's say, for you and Achim. What can you tell us about the cooperation with the EU on addressing BEPS issues?
Well, maybe I can start and just say that we've had very close cooperation. The European Union participates in all of our meetings and so has been directly involved in our work. We have also been very keen to ensure that we line up our work so that we don't end up with competing or different standards. And I think a lot of that you'll be seeing tomorrow when the ECOFIN is expected to announce a directive that will help to implement a lot of the measures. I don't know if Achim has anything further to add to that.
Just to briefly supplement, and that goes wider even than BEPS, we've done this in the area of automatic exchange where we have one global standard. We've seen it in the area of harmful tax where there's a code of conduct exercise. The way the EU looks at a patent box is exactly the same way we look at it. We work extremely closely. The same is true in hybrids and the implementation of that also, for instance, in parent subsidiary directive. So there's a very close cooperation, as Grace says.
Okay, that's great. Thank you very much. I'm going to stick with you, Achim. A question about country-by-country reporting. What happens if a country agrees to implement country-by-country reporting, but its domestic legislative process causes delays? Will a company based in such a country have to report in a different country as a substitute entity? a lot of questions about country-by-country reporting.
I'm just going to hand the question on. We sort of split it up. I do the exchange on the country-by-country, and she does the substance of the country-by-country. So hand it over to Marlies.
Thank you, Achim. Yes, so what happens if a country doesn't introduce ultimate parent country? The mechanism is quite clear. If kind of the ultimate parent cannot exchange the country-by-country report, the country that wants to get the report is entitled to do so if there is a treaty mechanism in place, but it's not kind of effective yet. So it will be up to the countries that are in the position of the local subsidiary to determine whether they want to wait or whether they think this is so important that they want to get it in through local filing.
I'm going to stick with country-by-country reporting for just a minute because there's so many questions on it, and I'll let the two of you fight over the answer. Will all countries use the same country-by-country reporting template until 2020? For which calendar tax year will each of the country-by-country reports, the master file, the local country file, be required? And when are they going to be exchanged? So a bit of a process there.
I start with the perhaps easier parts on the exchange piece. So as Marlies has said in the presentation, we're working on one XML schema, one format. We follow the template that we also used for the common reporting standard for financial account information. Makes it easier for companies, makes it easier for tax administration, makes it easier for everybody. So that's on the format. Second, on the timing, as Marlies has said, the first reports will be coming in 2018. There's a 6 months line and then there's a 3 months line. So those are the timelines. Those timelines will be included in the competent authority agreement, the multilateral competent authority agreement, where we've also said we're going to have a first signing ceremony in January of next year. So those are with respect to the timing and the format.
Yes, and then I will answer the question in relation to kind of the other elements not being the country-by-country report, and that is the local file and the global master file. So on that, we decided that those templates, for which there's also a template in kind of the report, should be given through local filing. So that means that the domestic countries can actually determine how they want to kind of when they want to introduce this and how they want to introduce this, kind of with the notion that kind of sticking as close as possible to these templates creates uniformity and coherence.
Marlies, I think we'll stick with you. A question on transfer pricing, and it's specifically on the toolkits that are going to be prepared for the low-income countries. How will that work be carried out, and are the developing countries going to be involved in the process?
To start with your last question, definitely they will be involved in the process. But to look at the whole process, so this is kind of work mandated by the G20 Development Working Group, and they have asked all international organizations involved in the tax area to work on these. So also the United Nations, the International Monetary Fund, and the World Bank are involved in this strand of work. And of course, they also have a lot of expertise in this area that we will bundle. And then what we will do is try to develop really practical toolkits, for example, on comparability issues for these developing countries. And of course, these developing countries will be involved. And we've actually already started it because during our work on commodities, it was already clear that this is an area where the work is going to be very important for them. So yes, developing countries will be closely involved. We will ask their opinions, their needs, and we will definitely draw on the solutions that they have already developed.
Yes, Larry, if I can just add to what Marlies has said. In fact, in identifying the issues that are the subject matter for these toolkits, we actually identify the issues through our discussions in the regional networks, in the global forum meetings we've had on the different issues, and that's how we came up with these topics. But as Marlies has said, as we discuss these issues with developing countries, we are seeing that there are other issues that we should also include.
Great. Thanks very much, Grace. We're bouncing around a little bit on questions, but one that we've heard about before, and Achim, you've spoken about before, but you may just want to reiterate. Do trademarks fall within the IP regime rules?
There's a very short answer given a limited time. Marketing intangibles are not included.
Given that we are just about running out of time, I think I have one final question here that I'm going to put to Grace, although if anyone else on the panel wanted to answer it, please jump right in. It's something we've talked about earlier. We talked about it in the previous webcast for the public. How long is it going to take for states to start implementing critical number of the BEPS actions till we really start seeing some results of the BEPS project and when we can really start measuring what's happening?
Thanks, Larry. I think that's a very good question. I think we'll be seeing implementation happen relatively quickly. Why do I say that? Because we've had so many countries spend so much time in developing these new measures. They haven't done it just because it's an academic exercise. They've done it, they've worked together because they think they need these measures to better administer their taxes. And so that's why you've had countries from Kenya, Nigeria, the Philippines, Australia, Colombia, Argentina, Brazil, and a whole range of other countries coming to Paris to work with other countries to develop these issues so that they can then be put in practice. We've already seen that some countries are moving ahead. I believe Ireland has already announced it's going to be one of the first countries to implement country-by-country reporting. I think we'll be seeing a lot of that, and so we should be seeing implementation very quickly. And of course, the multilateral instrument that we are developing is going to help implement the tax treaty related measures of BEPS very quickly, because instead of having to negotiate bilaterally or renegotiate each treaty, they'll be able to use the single instrument.
Grace, thanks very much. I'd like to thank all of you, the panelists, for your contributions here. It's quite an undertaking, and I think to put it all together in an hour and a half, explain it to a specialized audience is something you should be commended for. I'd like to thank everyone who's been watching this webcast and the previous 7, if I'm not mistaken. It's quite an undertaking on our side here, putting that together. It's the notion of transparency and inclusion is important on our side. We've made an effort throughout the process to keep the community, the tax community, and the public involved and informed. To that end, please continue discussing with us. You can continue sending emails to the address that you see there. You can continue following us on Twitter and the discussion. Thanks very much.